and audit reports. We know that this is an important topic which we require every one of us to have a very, very serious view on whatever going on in and around the amendments in the company law. Now that notice has started being issued by ROCs and all that, so at least we will try to minimize the mistakes or reduce the mistakes, general mistakes, which might hamper our or which might make us to reply or go behind the government departments. I also thank Kamal Garkar for immediately accepting our invitation in spite of his very, very busy schedule. And I was forcing him to do this program today. Otherwise, he said it will be only by next Saturday. I was pushing him to do it today. So he just allocated some 2 hours for us. I am definitely sure that these 2 hours will be our most knowledgeable hour for this day. I now request our treasurer, Priya Madam, to introduce our speaker to audience. Thank you.
Good evening. Good evening, all of you. Today we have with us Shri C.A. Kamal Garg ji, who's a fellow member of ICAI. He's from Delhi. He's an academic resource person, partner in KGMA, Delhi. He's qualified visa. He's also an insolvency professional. He's been member of Board of Studies and has been contributing to various research groups. He's been a member of Accounting Standard Board, Financial Review Reporting Group, and Peer Review Board of ICAI. He's been a regular guest faculty of IFRS Management Development Programs at various forums of ICAI and Institute of Company Secretaries as well. He has authored dozens and dozens of books and commentaries. The list is too exhaustive. I guess we need a full separate session to list down his books and his commentaries as well. He has a rich possession of industry knowledge and experience on various aspects under companies laws, under Companies Act, FEMA, taxation, foreign collaborations, joint ventures, etc., as well as audits and management consultancy. So today he is with us. We are very happy to have you here, sir. We welcome you to undertake a session on common mistakes in financial statements and audit reports. So with less time available, we hand over the session to you, sir. Thank you.
Thank you, Priya ma'am. So good evening to each one of you. I acknowledge the inspirational force, Geeta ma'am, for this Chengalpattu district branch of SIRC of ICI. I know her since long now, and I know she is quite instrumental for this branch. And I acknowledge the presence of my dear friend Raghavan sir. And especially, I must say that Raghavan sir is so kind to me that he always gives me an opportunity to interact with the people. And next level, I would be acknowledging the presence of Priya ma'am, who took the words of my introduction and very warm introduction, and I'm humbled with these introductory words. Coming to the topic given to me, the topic is common mistakes. So the good thing about this topic is at least we are admitting that we commit mistakes. So what I will be doing, I will be discussing the common mistakes in 2 tranches. One is the mistakes vis-a-vis Schedule 2nd of Companies Act. Schedule 2nd means useful life for depreciation purposes. And second, I will be discussing about common mistakes vis-a-vis Schedule 3. In my 25 years of experience, one thing has never undergone a change. And the thing is, audience always ask whether we'll get PPT. So the PPT will be circulated with you. I will be sending this PPT copy to the branch, and they will be ensuring to circulate this thing. But more than PPT, I would request the audience to keep their notepad and pen ready for certain core elements which I will be discussing, because everything is not in PPT. So I'll be sharing my experience as well. Now, before I share my screen and discuss the mistakes with you, let me discuss how I will be discussing the agenda. In my entire PPT, you will find there are 2 blocks, left-hand block and right-hand side block. Left-hand side block is mistake. So I would be asking questions to the house. I would be glad if you can answer my questions in the chat box or maybe by unmuting yourself. Then we will analyze whether answers given by you were correct or incorrect. This is what will happen. Your knowledge will not be confined only to PPT. You'll be able to absorb the knowledge. So this way we'll be discussing. So Priya ma'am, kindly enable my screen share so that I can share the screen. You have enabled, yes. Are you able to see the screen?
Yes, sir.
Okay.
Yeah.
So this is my topic, common mistakes in financial statements and audit reports. So first we will discuss about Schedule 2 and Schedule 3. Then we will discuss common mistakes in the audit report also. So the first tranche is about financial statements. So having said that, if you go to the financial statements, we need to understand why we need to follow the requirements. So there are legal requirements contained in the Companies Act itself. Now be very careful. I will be emphasizing on certain words. If you refer section 123 subsection 1 and 2, I repeat, if you refer section 123 subsection 1 and 2, the law says that no dividend shall be declared or paid by a company for any financial year except out of profits of the company for that year arrived at after providing for depreciation as per Schedule 2. Let me emphasize once again. What the law says, that dividend shall be paid or declared as the case may be only after providing depreciation as per Schedule number 2, number 1. Number 2, if you refer section number 198 subsection 4 clause K, section 198 subsection 4 clause K says, in making the computation of net profits of a company in any financial year for the purpose of section number 197. Now section number 197 is all about managerial remuneration. It says that in such a case, depreciation to the extent specified in section 123 shall be deducted. Just see the interrelation. For the purpose of managerial remuneration, depreciation to the extent specified in section number 123. That means section 197, 198 are interlinked with this section number 123. Now, having said that, if you refer Schedule 2, this is the snapshot of bare law. If you refer Schedule 2, Schedule 2 says, see section 123. See section number 123. What was section number 123? Section number 123 was that dividend shall be paid or declared only after providing depreciation. If you see the heading of Schedule 2, the heading of Schedule 2 is useful lives to compute depreciation. Meaning thereby, please listen to my words carefully and please take a note of this expression as well. Useful lives to compute depreciation. This is the expression, useful lives to compute depreciation. Now, what Schedule 2 is dealing with? Schedule 2 is dealing with useful lives to compute depreciation for the purpose of section number 123. Now, when we say for the purpose of section 123, the same purpose of section 123 is also interlinked for the purpose of managerial remuneration. Meaning thereby, what is the conclusion coming up? And hence the question. The conclusion and the question is to the House. Please try to resolve my query. Whether since providing depreciation is required only for the purpose of computing profits for dividend declaration and or managerial remuneration. So if you refer section number 123 here and section number 198 here, the conclusion coming out is, the conclusion is providing depreciation is required only for the purpose of computing profits for dividend declaration and or managerial remuneration. Having said that, the question arises, can it be said that if above two purposes are not there for the current financial year, then there is no need to provide depreciation in the books of accounts? Are you getting my question? The question is, if you refer section 123 and section 198, in the entire Companies Act, Schedule 2, useful lives of depreciation. This Schedule 2 is used only for two purposes. Purpose number 1, dividend declaration. Purpose number 2, managerial remuneration. Now the question arises, let us assume there is a company ABC Limited. ABC Limited is not desirous of declaring any dividend. Number 1. Number 2, ABC Limited is also not desirous of paying managerial remuneration. In such a case, can we say that there is no need to provide depreciation? Can we say that there is no need to provide depreciation? Yes or no? What is your answer? You can respond your answers in chat box or maybe by unmuting yourself. Yes, any answers? Priya ma'am, any expert advice from your side?
You need to provide depreciation, whether you have a managerial remuneration or you have a case of payment of dividend.
But where it is written, because the law says only for the purpose of section number 123. And that is what the common mistake is. That is what the common mistake is. We are providing depreciation not because of schedule second. I repeat, we are providing depreciation in financial statements not because of schedule second or section 123. We are providing depreciation because of accounting standards. Are you getting my point?
Yes.
So like I got one answer from Mr. Satish to comply with the accounting standard. That is the correct answer. So what I need to understand, please take a note. The note is, in the financial statements, depreciation is not provided because of schedule second. Depreciation is provided to comply with the accounting standards. And what is the accounting standard? It depends upon case-to-case basis. It could be either accounting standard or Ind AS, depending upon which company the client is falling into. And how it is written in section number 129. Just see how. Just give me a moment. If you refer section 129, what section 129 says? The financial statement shall give a true and fair view of the state of affairs of the company or companies. Comply with the accounting standards. Notified under section number 133 and shall be in the form or the form as may be provided for different class or classes of company schedule third. We will discuss schedule third separately. So primarily, section 129 subsection 1 is making it amply clear that the financial statement shall comply with the accounting standards. Section 129 is nowhere saying that you have to comply with schedule second. It is saying you have to comply with the schedule third. And that is the reason. Schedule second itself says that the useful lives of assets can be shorter or smaller. We'll discuss that thing separately. If you come to the auditor side, because section 129 is management side. If you come to the auditor's side, section 143, subsection 3 clause E says, auditor shall report whether in his opinion the financial statements comply with the accounting standards or not. So what is the conclusion? You can note this sentence in your notebook, that the conclusion is depreciation in the financial statements is not provided to comply with schedule second. It is provided to comply with the applicable accounting standards. When I say applicable accounting standards, this could be Ind AS or regular accounting standards. Am I clear? Any doubt over here? Let me see the chat box. So no doubt is there also. Now, having said that, let me proceed further. So this, whatever I discussed is written theoretically here. You can refer when you will get the PPTs. I'm not repeating this theoretical content. Now, schedule second. Just see the PPT, left-hand side block and right-hand side block. Just see. This is the example which I have taken from annual reports only. So various annual reports I have studied, and this is the policy which we have taken care of. Now, just see this paragraph. In one of the company's annual report, it was written in the notes to accounts, depreciation on property, plant and equipment is provided on straight line method over their useful lives and in the manner specified in schedule second to the Companies Act 2013. However, in respect of certain plant and machineries and electric installations, depreciation is provided as per their useful lives, assessed on the basis of technical evaluation by external valuer ranging from 20 to 40 years. Ranging from 20 to 40 years. My question for the house is, think and tell me without searching on Google, what is the non-compliance in this disclosure? And please be under right impression. Simply because I have highlighted something in yellow shade, that doesn't mean that only this is the non-compliance. Yellow shade here means this is the major non-compliance. That is the only indication. But yes, other non-compliances can also be there. Yes, any answer? What is the non-compliance? The very first non-compliance is, in this policy, they have not mentioned in accordance with applicable accounting standards. So they should have also mentioned in accordance with applicable accounting standard, meaning thereby schedule second simply gives useful lives. But how to depreciate, that is being given by accounting standards. So you need to recognize here applicable financial reporting framework. That is absent. Second thing is, if you see carefully, the words used are ranging from 20 to 40 years. This is a kind of common mistake, ranging from 20 to 40 years. Why it is a common mistake? Just see. As per the requirements of schedule second to the Companies Act, it was viewed that when different useful lives have been used by the company for the purpose of charging depreciation on PPEs, Such useful lives shall be specifically disclosed by the company by way of notes to the accounts. So it was thus required that proper disclosures regarding useful lives of plant and machineries and electrical installations should have been made, identifying the items of plant and machineries and electrical installations with their respective useful lives estimated by the external valuer. Are you getting the point? So instead of saying useful lives are ranging from 20 to 40 years, what was the requirement? Item number 1, plant and machinery, useful life 15 years. Let us take this way. Item number 2, electrical installation, useful life 40 years. Item number 3, generator, useful life, say for instance 12 years. So you have to give item by item disclosure of useful life. A blanket disclosure is not provided by the applicable accounting standards. So I believe this point is clear to each one of you. Now see the next one and tell me what is the mistake. Schedule 2 to the, this is the accounting policy company has given. Schedule 2 to the Companies Act introduce concept of useful life of asset instead of using specific depreciation rates as provided in Schedule 14 to the Companies Act 1956. Therefore, the company viewed that Schedule 2 to the Companies Act provides only straight line method of depreciation and any other method cannot be used. Is there any mistake over here? So just see this thing. Schedule 2 provides only straight line method. It is not so. It is not so. Just see. Schedule 2, in fact, is not specifying any method of charging depreciation, but is only providing the indicative useful life of assets. The company can use any appropriate method of depreciation such as SLM, WDV, considering the useful life of assets and other requirements as specified in Schedule 2 to the Companies Act. Therefore, the view of the company that Schedule 2 to the Companies Act provides only straight line method of depreciation is not correct. So most of the professionals are under misconception that Schedule 2 is providing method of depreciation. Dear friends, please underscore my words. It is only the applicable accounting standard which is envisaging methods of depreciation, SLM, WDV, production of units methods, etc., etc. Schedule 2 is not prescribing any method of depreciation. I believe this point is clear to each one of you. And just see, this is a very common mistake. Most of the corporates are even today writing this kind of accounting policy. Depreciation method is chosen as per Schedule 2. It is wrong. Depreciation method is given by accounting standard, not by Schedule 2. See this thing. Next, non-compliance. Tell me what is the mistake. So in one of the accounting policy of another company, what was written? Property, plant and equipment are stated at cost, net of recoverable taxes, trade discount and rebates, less accumulated depreciation and impairment losses, if any, computed in accordance with the methods prescribed under Schedule 2 to the Companies Act. Further, what they are writing, intangible assets are stated at cost of acquisition, net of recoverable taxes, trade discount and rebates, less accumulated amortization, depletion and impairment loss, if any, as computed as per the method prescribed under Schedule 2 of the Companies Act. What is the mistake over here? You know, the very first impression of reading these paragraphs, it will make you feel there is no mistake. But when you will read between the lines, you will find that mistakes are there. One mistake is this thing, method prescribed under Schedule 2. Just in the preceding PPT, I discussed Schedule 2 is prescribing no method. What is another mistake? Another mistake. Just see this word, impairment. Focus on this word, impairment, and then decide, is there any mistake here? Ask yourself whether Schedule 2 is dealing with impairment losses. Answer is no, a big no. And this is the mistake. Just see. The conclusion is Schedule 2 does not specify any method of charging depreciation, but only provides the indicative useful life of the assets. The company can use any appropriate method of depreciation such as SLM, WDV, considering the useful life of assets and other requirements as specified in Schedule 2. Further, Schedule 2 also does not deal with impairment of assets. Para 2 of Schedule 3, in fact, states that for the purpose of this schedule, sorry, this is the typing error, this is Schedule 2. Para 2 of Schedule 2, in fact, states that for the purpose of this schedule, the term depreciation includes amortization. So Schedule 2 deals with depreciation and amortization, but it is not dealing with impairment. So therefore, the policy stated by the company is not correct. I believe this point is clear to each one of you. And there's a typing error. Please excuse me for that. This is not schedule 3rd. It is schedule number 2nd. Am I clear? So what you learned from these two PPTs, PPT number 1 was saying that schedule 2nd is not providing any method of depreciation. What is second learning? That schedule 2nd is not dealing with impairment of assets. It is only dealing with depreciation and amortization. Shall I proceed further? I believe there is no doubt in the chat box also. Yes, no doubt. See this clip and tell me what is the mistake. Depreciation on property, plant and equipment is provided on straight line method over their maximum useful lives as specified in schedule 2nd to the company's acts, except where different useful lives are adopted on the basis of technical advice obtained by the company from independent experts. What is the mistake over here? And please don't tell me that mistake is maximum useful life. I want to know how this maximum useful life is a mistake. Any answer? Let me see the chat box. Some replies here. The reply is method is not specified. Okay, first mistake is about method. So you captured very right. Straight line method. And what is second mistake? What is the mistake vis-a-vis maximum useful lives? Okay, let me ask you a question in a different way. Whether schedule 2nd is prescribing any maximum useful life. Whether schedule 2nd is prescribing any maximum useful life. Answer is no. In fact, schedule 2nd is neither prescribing you minimum life nor prescribing you maximum life. They are only the indicative lives. So just see the mistake. The useful lives as given under schedule 2nd for various types of assets are indicative only. They are neither minimum nor maximum. And what the schedule 2nd says, where useful lives of various specific assets are same as those under schedule 2nd, the company should use these useful lives. In case the useful life of an asset as estimated by the company, supported by the technical advice, external or internal differs, that is higher or lower from the indicative useful life given under schedule 2nd, the former should be applied by the company for providing depreciation. I believe this point is clear to each one of you also. So what is the point of contention here? First is method is not prescribed by schedule 2nd. Second is even maximum useful life is not given by schedule 2nd. It is only the indicative life. So what they are giving you only indicative useful lives as per schedule number 2nd. I believe this point is also clear to each one of you. Having said that, see this question. One of the policy was depreciation on those assets whose actual cost does not exceed rupees 5,000 has been provided at 100% in accordance with schedule 2nd of the Companies Act. What is the mistake over here? In my experience, this policy, which you are able to see on the screen, is the most common mistake prevalent in the CF fraternity. One of the answer is by my beloved friend Raghavan sir. No minimum value provided, right? Correct answer. This is the correct answer. This schedule 2nd is not dealing with any low value items. Prior to this, when we were having schedule 14, low value items were discussed. But in schedule 2nd, no low value concept is there. And that is the correct answer. So what the requirement is? Schedule 2nd is not providing or prescribing any such requirement to provide depreciation at 100%. Guidance note on schedule 2nd. This GN means guidance note on schedule 2nd states that as the life of the asset is a matter of estimation, the materiality of impact of such charge should be considered with reference to the cost of asset. The size of the company will also be one of the factors to be considered for such policy. Accordingly, a company may have a policy to fully depreciate assets up to a certain threshold, considering materiality aspect in the year of acquisition. Meaning thereby, this 5,000 benchmark is no longer existing. You can have 5,000 benchmark, 50,000 benchmark, 10,000 benchmark, depending upon case-to-case basis. So I believe this point is clear to each one of you. So in current year, if any one of your client is providing depreciation on the basis of this policy, the policy will go wrong. Unless and until you are able to substantiate that in your case, 5,000 itself was the materiality level. Up till here, if you have any query, you are most welcome to ask. Otherwise, I will start with schedule number 3rd. So Raghavan sir, any query?
Sir, I got one question.
Yes, sir.
See, mobile phones. bought by the company. See, it is classified as plant and machinery. Okay, for depreciation purposes, classified as. But I want to write off the mobile phone in a single year. Whatever be the value, values, because phones are being outdated in every single year or second year. Is it right that I charge this mobile phone directly to the P&L based on the management depreciation?
See, the thing is, let us take this question in a much more expensive way. If I'm purchasing a cell phone or a cell instrument for, let us say, managing director,
Yes.
I may write it off this amount in the P&L, considering one part of salary itself, perquisite. But let us take the situation a different way. I bought 10 cell phones for my field staff. In that very case, on individual level, this could be immaterial, but on aggregation level, it is material. So I will capitalize the entire purchase of cell phones. However, because cell phones generally do have lower shelf life, say max to max 2 years. So in that very case, what I will be doing, I will be providing accelerated depreciation. How I will be providing accelerated depreciation? By estimating the useful life, say for 2 years. So automatically depreciation would be on a higher side. Meaning thereby on case-to-case basis, I need to check the materiality. Say, let us take this way. If you are running a call center, in case of call center, the cell phone available with the staff will be capitalized because it is in bulk. If you are running a CA firm and you're providing your cell phones to each and every article assistant, again capitalization. But if you are purchasing a cell phone for yourself as one of the partner in CA firm, then it may be debited to P&L as a wholesale lump sum cost. So depending upon case-to-case basis, we have to devise upon materiality policy.
But if it is coming to corporate, fatal, I want to write it off because it is given to salespersons or plant people, whatever it be. I want to provide accelerated depreciation. The kind of documentation from the management, is it enough that I give it in only MRL?
That MRL will not be sufficient. You need to take the help of some expert.
What kind of documentation will be sufficient? Their resolution.
The expert could be depending. It could be dependent upon how far you're going to use the cell phone. Say, for example, your staff is going to use cell phone on frequent basis because they are the frequent callers. In that very case, the cell phone would be damaging itself on a frequent basis. Wear and tear will be so fast. In that very case, depreciation will be accelerated. But for this purpose, you need the expert report. The expert report can be given by any IT professional. So you need to search for the IT professional. The fact is, ground reality is to search IT professional for depreciating 2 or 3 cell phones itself is a costly affair. In that very case, you can take a note. In that very case, SA 540, auditing standard number 540. That could be helpful. SA 540 says in certain cases, management estimates can be accepted by the auditors. How they will accept those management estimates, I will not go into depth at this session. You can refer SA number 540. One of the principle is management estimates are acceptable when the estimates are free from any bias. Now, what that biasness is, that SA 540 will tell you. Okay, sir.
Thank you, sir. Thank you.
What I do practically in my case, I will apply simple logic. Say Raghavan sir is my management. He will say this cell phone is worth for only 1 year. After 1 year, it is of no use. So what I will do, I will go to the OLX website. On OLX website, I will feed the model number of this cell phone, and then I will check how much money I will get if I sell this cell phone in the market. If the money is almost negligible, then it means that it is fully depreciated. Matter over. This could be taken as a kind of indicative sense.
Any replacement, whatever be the any equipment replacement, whether it is a cell phone or laptop, maximum 2,000, 3,000. That's all.
But that again depends upon case to case. So we have to be subjective that way.
But proper documentation is to be there.
Yes, that is required, and especially if you are covered by NAFRA, then documentation is extremely important. Shall I start with Schedule 3 now?
Yes, sir. Yes, sir.
So you know very well, Schedule 3 was amended recently. Now, what is happening of late? People are not committing mistakes in amendments, but people are committing mistakes in what was there in Schedule 3 right from 1st April 2014. So whatever new things came in, no mistakes primarily, but in old things, mistakes are being committed. So I will discuss in Schedule 3 here. And you know this thing also that Schedule 3 deals with preparation and presentation of financial statements. Many people are having a misconception. The misconception is Schedule 3 deals with recognition and measurement principles. No. Schedule 3 is not dealing with recognition and measurement. Schedule 3 only deals with preparation and presentation. So Schedule 3 is not telling you debit and credit rules. Schedule 3 is only telling you how to have the format of financial statements. When I say format means balance sheet, P&L, not cash flow. So even cash flow statement is not dealt by Schedule 3. So some people are committing mistake this way also. They're writing that the company has prepared and presented balance sheet, P&L and cash flow as per Schedule 3. I'm sorry. Cash flow is not there in Schedule 3. The proper sentence is balance sheet and P&L have been prepared as per Schedule 3. Have been presented as per Schedule 3. Cash flow is not there in Schedule 3. So with this small background, let us discuss one by one. So this is the format of balance sheet. As far as Schedule 3 is concerned, so I will not go into the format. You know this amendment was there. This yellow shade is nothing but the amendments which took place by March 2021 notification. Total revenue was substituted with total income. So these amendments I'm not touching upon because the question is not about what are the amendments. The question is about what are the common mistakes. So just see this one. So all these are extracts from the corporates only. So I was going through the annual report of one of the corporate and I found this kind of non-compliance. You tell me what is the non-compliance. So Schedule 3 requires all items in the balance sheet to be classified into current or non-current. We know very well. One of the underlying criteria of classification into current and non-current is operating cycle. No disclosure was made for operating cycle. So question for the house is whether no disclosure about operating cycle is any kind of mistake or not. And if it is a mistake, then where it is written, it is a mistake. Because it will be very easy for you to say, yes, it's a mistake because Kamal has done the highlighting area. So my question to the house is, if it is a mistake, then why it is a mistake? Where it is written that you have to disclose the operating cycle. Is it written somewhere? Yes, any answer? Is it so let me change my question. My question is there any accounting literature which mandates that the corporates shall disclose operating cycle? Yes, any answer? No answer? Raghavan sir, any answer from your side? Or shall we do pass? Okay, pass. Just see, very simple answer, very simple answer. Guidance note on Schedule 3. So guidance note on Schedule 3, this GN means guidance note on Schedule 3. Guidance note on Schedule 3 recommended that the disclosure about company's operating cycle shall be given as a part of notes to the financial statements. So when they say recommended, guidance note, when they say the word is recommended, it is almost mandatory. So what the guidance note says? Guidance note says that you have to disclose operating cycle in notes to the financial statements. So if your operating cycle is not identified, then Schedule 3 says, if operating cycle is not identified, we will presume it is 12 months. Even if it is presumed to be 12 months, still, please recommend your clients that in notes to accounts, they should give a statement. The statement shall be, the company's operating cycle is 12 months, matter over. At least there would not be any apparent mistake. So the bottom line is, in notes to accounts, one of the note shall be about company's operating cycle. That company's operating cycle is XYZ months. Whatever months of operating cycle is there, we have to disclose. Number second, see this thing. In one case, notes to accounts stated that company's operating cycle is 6 months. The sale contract provides for normal credit period of 3 months. However, the company does not expect to receive the payment within 12 months from the reporting date due to ongoing litigation with the customer. So operating cycle is 6 months. However, the company is not expecting to receive the money from one of the trade debtor within 12 months from the reporting date, that is balance sheet date. Still, the company classified trade receivable for such customer under current asset category. Most of the population is under impression that trade receivables and trade payables always are current. This is the misconception. Trade receivables and trade payables can also be non-current. When they can be non-current? They can be non-current when the management expects that trade receivables will not be received within either the operating cycle period or within the 12 months period from the reporting date, whichever is lower. In my case, what the lower thing is? Operating cycle 6 months. So meaning thereby, in this case, the company should have classified trade receivables into non-current assets category, not current asset category. So what is the requirement? The guidance note requires that since the company does not expect to receive the payment within 12 months from the reporting date, the same should be classified under the heading non-current assets in the balance sheet. Are you getting my point? So please come out of this impression that trade receivables are always current. No, trade receivables can also be non-current. This is not easy. This is not easy. Let me go back to the format of balance sheet. And please don't watch my previous webinar. Otherwise, you will get the answer. You have to answer now promptly without referring the previous discussions. Just see this non-current asset and see current asset. If you refer current assets, we have the item trade receivables. But if you see non-current assets, there is no item of trade receivables. Now the question arises, assume that in your company client, there is one item non-current trade receivable. If your client is having non-current trade receivable, shall I add point number F here and write non-current trade receivables? Can I add one line item on my own as non-current trade receivables? Can I do so? Yes or no? Answer is no. Please take a note. Please take a note. You cannot add a new line item over here regarding trade receivables. If there are trade receivables which are falling into non-current category, then they will be dumped into the heading of other non-current assets. So other non-current assets, below this in notes to accounts, you will give the breakup, and the breakup will include one more item. The item will be trade receivable. So Raghavan sir, your answer is correct. So what you need to understand, each one of you, if your client is having non-current trade receivables, they will be reflected below the main caption, non-current assets, sub-caption, other non-current assets, and the breakup will be trade receivable. I believe this point is clear to each one of you. Let me move forward. See this question. In one case, investments were classified into current and non-current category under Schedule 3. Whereas accounting standard 13 requires to classify the investments as current and long-term. You know very well, Schedule 3 says accounting standards will prevail over Schedule 3. Now the conflict is coming up. The conflict is Schedule 3 classifies the items of assets into current and non-current. One of the asset item is investments. AS 13 dealing with investments states that investments shall be classified into current and long-term. So Schedule 3 says current and non-current, and AS 13 says current and long-term. So still the company did not make appropriate disclosures about investments under Schedule 3 as to the classification in tandem with AS 13. So basically what is happening, Schedule 3 and AS 13 are in conflict with each other. And when we will be preparing financial statements, we will be presenting financial statements, we have to give the harmonious preparation and presentation. In order to give harmonious preparation and presentation, I need to ask you people how to harmonize the requirements of Schedule 3 and AS 13. But before that, there are different questions. What is the distinction between non-current investments and long-term investments? Distinction between non-current investments and long-term investments. Any answer? Karthik ji, for income tax, just wait for some moments. It is also one of the common mistakes. So I will come to that thing also. So there is a question from Karthik ji. This question will be discussed in some moments because it is also one of the common mistakes which I will be discussing. Yes, how far my question is going to be answered now? Distinction between non-current and long-term. So I got one answer from my another friend, Arumugara sir. Non-current investments are long-term investment. This is a very diplomatic answer. So it's a diplomatic answer. I cannot say this answer as correct answer or wrong answer. No, again, one more answer is there, but the answer is wrong. So please note my words and you can take a note. Non-current investments are the investments which are expected to be realized after 12 months from the balance sheet date. I repeat, non-current investments are the investments which are expected to be realized after 12 months from the balance sheet date. Now listen again. On the other hand, long-term investments. So first I define non-current. Now long-term. Long-term investments are defined by AS 13. And AS 13 says long-term investments are those investments which are expected to be realized after 12 months. Now be careful, from the acquisition date. From the acquisition date, purchase date. I repeat one thing once again. First is non-current. Non-current investments are those investments which are expected to be realized after 12 months from the balance sheet date. So for non-current, the triggering point is balance sheet date. On the other hand, AS 13 says long-term investments are those investments which are expected to be realized after 12 months from the acquisition date, or you can say purchase date. So triggering point here is purchase date. So what is the conclusion? The conclusion is guidance note states that though the Schedule 3 clarifies that accounting standards would prevail over itself in case of any inconsistency between the two, AS 13 does not lay down presentation norms, though it requires disclosures to be made for current and long-term investments. Hence, what is the requirement now? Hence, the portion of long-term investments as per AS 13, which is expected to be realized within 12 months from the balance sheet date, needs to be shown as current investments under Schedule 3. So what will happen? You will take the long-term investments as per AS 13, then you will do the splitting. Splitting means the portion of long-term investments which falls within 12 months will be going towards current investments. Balance will go into non-current category. And when you will shift to current, what you will be captioning it? The captioning will be current portion of long-term investments. Current portion of long-term investments. Am I clear? And just see, this is one of the common mistake. Who knows? Most of the listeners amongst us are also committing this mistake. I believe this point is clear to each one of you. Now let me proceed with the next mistake. So this is the question which even one of the participants was asking. This will be resolved here. In one case, deferred tax liability was classified into current and non-current category. In another case, deferred tax asset was also classified into current and non-current category. The basic question is whether deferred tax assets or liabilities, as the case may be, needs classification into current and non-current category, because Schedule 3 says each item of asset and liability shall be classified into current and non-current. So whether we need to classify deferred taxes, assets or liability, as the case may be, into current and non-current category. This question assumes special significance for one more reason. The reason is the format of balance sheet itself. If I go back to the format, you see the format of balance sheet. In non-current assets, we don't have, in non-current assets, we have deferred tax assets. But in current assets, we don't have any deferred tax assets. Similarly, in non-current liabilities, we have deferred tax liabilities. But in current liabilities, we do not have any deferred tax liability. So question arises whether deferred taxes, asset or liabilities, as the case may be, need classification into current and non-current. Yes or no? Any answer? Answer is no. Deferred taxes always will lie in non-current category, irrespective of whether they are assets or liabilities. The same thing is written in Ind AS also. So guidance note stated that with regard to the presentation and classification of deferred tax assets or liability, the same should always be classified as non-current. I have seen balance sheets where people have categorized deferred taxes into current and non-current. No, it is not allowed. Deferred tax assets or liabilities, as the case may be, shall always be considered under non-current classification. I believe this point is clear to each one of you. So Karthik ji, this was your question as well. I believe I have answered your question as well. Anyway, I'm glad to get the response from Mr. Karthik. Meanwhile, I can proceed further. See this question. In one case, there was a convertible debt where conversion option lied with the issuer. So let us assume there's a company ABC Limited. ABC Limited issued convertible debentures. And when this debenture will be converted into equity, this option is with the company ABC Limited itself. In another case, there was a mandatorily convertible debt instrument. So in both the cases, what happened, such convertible debt was classified into non-current category on the grounds that Schedule 3 states that the terms of liability that could, at the option of counterparty, please focus on these words, option of the counterparty, result in its settlement by the issue of equity instruments do not affect its classification. Meaning the Schedule 3 is saying, if you issued some convertible debentures and the option of getting it converted is with the counterparty, that means the investor. In that very case, the classification will not be impacted. The classification will be non-current. Question arises whether this same analogy can be applied even when the option to exercise the conversion is with the issuer and not with the investor. Yes, any answer? The answer is no. The same analogy cannot be applied. It is written by guidance note also. So what guidance note says? Guidance note says that based on the specific exemption granted only to those cases where conversion option is with the counterparty. So this exemption is only with the counterparty conversion option. The same should not be extended to other cases where such option lies with the issuer or is a mandatorily convertible instrument. Hence, the timing of such settlement would also decide the classification of such liability in terms of current or non-current. So meaning thereby, simple thing. If the counterparty has the option to get it converted, you will classify it as non-current. You cannot apply the same principle to your own case if you are having the conversion option as an issuer. I have some responses from Mr. Karthik. Mr. Karthik is writing, and in guidance note of Schedule 3, income tax assets or liabilities of expected not to be settled in 12 months time, it should be treated as non-current assets or liabilities. This I already covered. Then he's writing, my question is whether on the face of balance sheet, it should be mentioned or in other assets. Should be, Karthik ji, this is itself given in the balance sheet. If you see the balance sheet, deferred tax itself is one of the line item. Let me show you. Deferred tax is already one of the line item. So no need to go into the notes to accounts. In notes to accounts, you will disclose only the reconciliation of deferred tax items. I believe this point is clear. So deferred tax asset itself is one of the line item. There is no need to travel into other categories. Okay. Series non-compliance. In one case, there was unpaid amount towards shares subscribed by the subscribers of MOA. MOA means Memorandum of Association. The company hence gave a descriptive note for the same without any treatment in the financial statements. Let me make it practical. Let us assume, you can note this data in your notebook. Let us assume a company was incorporated on 26th December 2021. A company was incorporated on 26th December 2021. The subscribers to the memorandum promised that they will bring in the subscription money of rupees 5 lakhs. Section 10 capital A of Companies Act says, subscribers shall bring in the subscription money within 180 days of company's incorporation. Now, as on 31st March 2022, as on 31st March 2022, that is the financial year ending on 31st March 2022, 180 days are yet to expire. And this money of rupees 5 lakh was not brought in by the subscribers. So question arises, as on 31st March 2022, shall the company give in notes to accounts that subscribers are yet to bring in subscription money, or the company is also required to pass any journal entry in the books of accounts so that the same should be reflected in balance sheet also? Notes to accounts are okay, notes are required, but whether any treatment is required in books of accounts and corresponding financial statements or not. I believe my question is clear. Company was incorporated on 26 December 2021. Because the company was incorporated prior to 1st January, its financial year will be ending on 31st March 2022. This is known to all. Subscriber stated we will bring in rupees 5 lakh as a subscription money, but they never brought in the subscription money because 180 days never expired on 31st March. So still some time was there with them. So as on 31st March, whether any accounting treatment is also required? That is the question. So like answers are there, but incomplete answers are there from both of my dear friends. So one friend is saying treatment required in books of accounts, matter over, because this answer is silent about what treatment. The other friend is giving partial treatment, subscription money due from not directors, from the subscribers, asset side. So let us see, journal entry will be, if I go by these two answers, the journal entry will be subscription money receivable account debit to fill in the blanks. What shall I write in fill in the blanks? So answer is a share capital. Is it written somewhere that it is share capital? Because capital is yet to be allotted. So please take a note. Answer is correct. I am not doubting the answer. Rather, I am asking a counter question. Is it written somewhere? Answer is yes. Please take a note. Section number 2, clause 64. Section number 2, clause 64 defines paid up capital. And this money, which is receivable from subscribers by virtue of section 10 capital of Companies Act, that 180-day period, makes this capital as a deemed capital. So the correct journal entry is subscription money receivable account debit to paid up share capital account. So what will happen in balance sheet on asset side, it will be current assets, subscription money receivable, and on the equity and liability side, it will be shown as paid up capital. This paid up capital is not actual paid up, rather deemed paid up. And that is what the mistake was there. So conclusion is, you see the conclusion. Section 2, clause 64 and section 10A of the Companies Act read with the guidance note requires that unpaid amount towards shares subscribed by subscribers of memorandum of association should be considered as subscribed and paid up capital in the balance sheet, and the debts due from the subscriber should be appropriately disclosed as an asset in the balance sheet. So in my question, what happened? They gave note treatment in financial statements, only notes to accounts. Both the things are required. In balance sheet, you also need to give, and in notes to accounts, you also need to give. Am I clear? So whosoever is listening me, if they have the clients who have incorporated their companies afresh in year 21-22, please make it sure that this amount receivable from subscribers is properly reflected in the financial statements. Priyaji, this is not required. We should not use the word deemed share capital. The deemed share capital is only a common parlance word. So as a common parlance, customary words we can use on seminars and webinars, but technically the words are subscribed and paid up capital. So deemed share capital words are not used by the Companies Act. I use these words just to cover the lecture as an example. I believe this point is clear to each one of you. See this thing and tell me what is the mistake. In one case, a reconciliation of the number of shares outstanding at the beginning and at the end of the reporting period was given. So equity share capital, number of shares at the beginning, and then issued, redeemed is equal to closing balance. It was given. The company, however, gave such a reconciliation for total number of shares in aggregate, Whereas the notes also stated that company had issued equity shares as well as preference shares. What is the mistake here? Simplest question. Just see the mistake. The guidance note in Schedule 3 requires that to make disclosures relevant for understanding of the company share capital, the reconciliation is to be given even for the amount of share capital, So what is happening here? They have given the total number only. Guidance note says also give the amount. Further, guidance note requires that the company should also disclose separately this reconciliation for equity and preference. So the movement of equity and preference shall be disclosed separately. You cannot add them up. And number third, the reconciliation is required not only for the current period, but also for comparative period. So comparative information is also required. Simple only, nothing is tough. What is the special point here? The special point is amount. I will not say that B and C are not important. Most of the people are doing B and C. Only some are not doing. But most of the people, or I should say majority, are not complying with this amount disclosure. So number of shares need to be disclosed along with the amount of such shares. There is a question in the chat box by Arunji. What happens if there is an excess share capital received? Can we disclose this as current liabilities? Yes, sir. Arunji, this will be current liability. Quite obvious. It is the current liability. So we'll reflect this as a current liability, but I would suggest if this excess capital is received, please also refer your articles of association, whether any interest is required to be given on this excess capital received by you or not. Because what happens when we incorporate a new company, generally the prevalent formats of articles of association are used. So whatever format Priya ma'am is using, you will also use, I will also use, Raghavan sir also will use. So common formats are used for articles of association. And in some of the articles of association, there is a provision regarding interest to be paid on excess money being received towards share applicants. So in that very case, you have to consider whether interest liability needs to be provided for or not. Moreover, if this money is not allotted within 60 days and is not refunded after expiry of 60 days, in 15 days of time. So overall span is 75 days, 60 days of allotment. If not allotted, 15 days of refund. Then from 76 day, it will be deemed as deposit. So that we also need to take care of. Even Priya ma'am has also replied this way. More than 60 days deemed to be deposit. There is one more question from Arunji. If the member is a foreign member, should we have to deal with anything in relation to FEMA? So FEMA still uses 180 days window of allotment. But company law is using the 60 days window of allotment. In that very case, we have to reconcile the both. So in order to comply FEMA, we cannot contravene Companies Act. In that very case, your 180 days period given by FEMA will be cut short to 60 days as per Companies Act. I believe this point is clear to you, Arunji. Okay. Let me move forward. Just see this thing and please tell me the non-compliance. In one case, shares in the company held by each shareholder holding more than 5% shares was given by specifying the number of shares held. The company, however, gave such shareholding for total number of shares in aggregate, whereas in notes also stated the company had issued equity shares as well as preference shares. Quite a similar question to the preceding one. So what is the conclusion? Guidance note requires that companies should disclose the shareholding for each class of shares, both within equity and preference shares, and this information should also be given for comparative previous year. So this non-compliance is quite similar to the previous one. So I will not repeat the things again, but I believe the things are clear. The things are comparative information is also required. Equity preference shall be separately disclosed and that too with the amount. See this thing. In one case, the loan payable by the company was converted into equity under an arrangement between the company and the lender. The company disclosed the same as shares allotted as fully paid up pursuant to the contracts without payment being received in cash. Why this point is important? Because clause number 1 of note 6A of part 1 of schedule 3rd, or I should say simply schedule 3rd. Schedule 3 requires the companies to provide separate disclosures for shares allotted for other than cash. So question arises whether this is proper disclosure. If loan is converted into equity under a settlement scheme provided by the lender, shall we say that it is the share allotment for consideration other than cash? Is it correct? Any answer? Is it correct? No answer? Ask yourself a question. When you allotted the shares for loan, whether this loan was received by you in cash or not. When I say cash, cash means bank also. Answer is yes. The loan was received by you in cash mode or cash equivalent mode. So basically you are allotting shares in cash only. So allotment of shares for the purpose of converting the loan equity to equity is nothing but shares are allotted for cash, because cash are received by you at the time of loan itself. at the time of loan itself. So in addition to checking the compliance of company law, compliance regarding section number 62, section number 71, in certain cases, debentures are there. Depending upon that, the one thing will remain common. The common thing is this kind of allotment is nothing but allotment for cash only. And the thing is given by guidance note also. Guidance note requires that such an allotment is considered as shares allotted for payment being received in cash and not as without payment being received in cash. And accordingly, the same is not required to be disclosed under this clause. What was this clause requiring? This clause was requiring to make separate disclosures for non-cash allotments. I believe this point is clear to each one of you. And I'm presuming that when this conversion took place, the applicable requirements of Companies Act were complied with. For example, section number 62, section number 71, and so on. See this thing? In one case, the company made a separate disclosure of shareholding of its promoters, including the percentage change during the year. The company disclosed the same in format prescribed under Schedule 3, which required disclosure only in respect of shares held at the end of year. Is there any mistake over here? This is the amendment also, you know. This year, this is the amendment in Schedule 3, disclosure about promoter shareholding. Yes, any answer? Simple question only. The guidance note requires that company should also disclose the number and percentage of shares at the beginning of the year as an additional columns in order to facilitate an understanding of the percentage change during the year. Are you getting my point? So what happened here? They disclosed only percentage change during the year. Opening balance was not given. So we have to give opening balance, closing balance, and then we have to compute the percentage change. I believe this point is clear to each one of you. Shall I proceed further? And this is the amendment, because this clause number M was introduced by virtue of March 2021 notification, which requires in Schedule 3 you have to give disclosures about promoters shareholding. Okay, next question. In one case, the company received calls in advance from some shareholders. The company disclosed the same as part of paid up share capital. So let me remind you, we have section number 50. In terms of section 50, a company, if so authorized by its articles of association, may accept from any member the whole or part of the amount remaining unpaid on any shares held by him, although no part of that amount has been called up. So calls in advance can be received. Answer is yes. Where it is written, section number 50 of Companies Act says so. So question is, this calls in advance amount was disclosed by companies as a part of paid up capital. Is it right? Can we show it as a paid up capital amount? Answer is no. Answer is no. And the big logic is this capital is yet to be allotted for calls in advance. So it will not become capital merely on advance receipts. And the same thing is captured by guidance note also. The guidance note says the shareholder who has paid the money in advance is not a creditor for the amount so paid as advance, and the same cannot be demanded for repayment, and the company cannot pay him back unless articles are provided. Hence, calls paid in advance are to be reflected under other current liabilities. Calls paid in advance are to be reflected under other current liabilities. Similar view was also expressed by Department of Company Affairs in year 1961. So what you need to remember, calls paid in advance shall be reflected under the heading other current liabilities. Shall I proceed further? I believe this point is clear to each one of you. See this thing. In one case, the company was having long-term borrowings. The company nowhere separately disclosed the current maturities of such long-term borrowings. Is there any requirement in Schedule 3 to disclose current maturities of such long-term borrowings? Answer is yes. And this year, there is an amendment also. So I have covered both. Till 31st March 2021, that means prior to amendment. Till 31st March 2021, current maturities of all long-term borrowings were required to be disclosed under other current liabilities. This is a scenario prior to amendment. Now, after amendment of Schedule 3, now from 1st April 2021, the current maturities of long-term borrowings will be disclosed under short-term borrowings and not under other current liabilities. So what happened? See, we must accept one thing. We do suffer from copy-paste system. And because the last year balance sheet was used this year also, after some changes as per Schedule 3, one of the change which a member left to be made was current liability and short-term borrowings. So what you need to remember, this current maturity of long-term borrowing. So you have a loan for 5 years. Whatever loan amount is going to be repaid in immediate next 12 months is the current maturity of long-term borrowing. That current maturity of long-term borrowing earlier was reflected below other current liabilities. Now it will go into short-term borrowings. That is the change which has taken place from 1st April 2021. So whatever change has happened from 1st April 2021, corresponding comparative will also be changed. Because in the corresponding previous year, you are reflecting it as other current liability. So in the comparative year for year 21-22, you will have a change again. Are you getting my point? Now, see this one. In one case, the company was having secured long-term borrowings. The company disclosed that all long-term borrowings are secured against tangible assets owned by the company and personal security of promoters, shareholders, and third parties. Personal security of promoters, shareholders, and third parties. Is there any mistake over here? What is the mistake over here? Focus on these words: personal security of promoters, shareholders, and third parties. Is there any mistake over here? Very simple answer. Just see the answer. Guidance not requires that. 3 mistakes are there. A blanket disclosure will not suffice, and hence nature of security shall also be specified separately in each case. So what they are doing? They are saying all long-term borrowings are secured against tangible assets. You have to say long-term borrowings are rupees 1,000 crores. Out of 1,000 crores, 500 crores are secured by plant and machinery. 200 crores are secured by land. 300 crores are secured by building. This way you have to give the item by item disclosure, not a blanket disclosure. Guidance note also requires that nature of security should also cover the type of asset given as security. For example, inventories, property, plant and equipment, intangible assets, etc., which I already covered. This point number C is extremely important, extremely important. I told you also, focus on the words personal security of promoters, shareholders, and third parties. So what guidance note says, when promoter, shareholders, or third party gives any personal security for any borrowing, such as shares or other assets held by them, disclosure should be made thereof, though such security does not result in classifying such borrowings as secured. So borrowings shall be deemed as secured only when these are secured under the assets held by the company. If some third party, shareholders or promoters are providing any kind of assurance, that is not secured borrowing. Are you getting my point? So we have to be very careful. Disclosure is required, but we will not say that they are secured borrowings. Are you getting my point? So this is a very important thing. See this question. In one case, the company was having some leasehold improvements. The company disclosed leasehold improvements by clubbing the same under assets held under lease. First of all, tell me, what is leasehold improvement? How many of you know what is leasehold improvement? Please don't search in Google. Raghavan sir went beyond the camera. That means Google is on.
I'm always here, there. Don't worry.
So what is leasehold improvement? Any answer? Let us take a situation. You took an office on lease. So a room was given to you. Can you sit in the room without any furniture, without any AC, without whitewash, without curtains? Answer is no. That means you have to sometimes require refurbishment of the leasehold premises. So whatever expenses you incurred to make the leasehold premises fit to be accommodated, you incurred certain expenditure. And that expenditure is capital in nature, like installation of AC, installation of electrical gadgets, etc., etc. CCTV, for example. All these are leasehold improvements. So you installed CCTVs in your office, leasehold improvement example. Ask yourself whether the CCTV, which is a leasehold improvement, can be categorized as assets held under lease. Is it lease? Answer is no. You never took CCTV on lease. It is your own asset. It is your own asset. Are you getting my point? And that is the mistake we people are committing. Leasehold improvements are my own assets. And that's the reason they should be shown as separate assets. Are you getting my point? I believe this point is clear. So in your office, you have CCTV, you have curtains, you have furniture. Don't club these things in assets held under lease. What will happen? You will go to the format of balance sheet. Main format is PPE, property, plant and equipment. Below PPE, you have a sub item. You have to make a sub item. The sub item name would be leasehold improvements. And these leasehold improvements shall be depreciated over the useful life of, not the lease, over the useful life of the assets under leasehold improvement. Am I clear? Shall I proceed further? Okay. See this question. In one case, the company was having some investments in LLPs. So this is a company ABC Limited, and ABC Limited invested in the partner's capital of LLP. Company can be a partner. The company disclosed the same under the subheading investments in partnership firm. Why this is important to discuss? Because Schedule 3 requires disclosure in regard to investments in the capital of partnership firms, the name of the firms with the names of all their partners, total capital and shares of each partner. So question is, whatever investment the company made in LLP's capital, shall it be disclosed as investment in partnership firm? Ask yourself whether LLP is a partnership firm. Answer is no. And that means if you are investing in LLP, you cannot club the same in investments in partnership firm. That's a mistake. So what the guidance note says? Guidance note says that LLP is a body corporate and not a partnership firm. Hence, disclosures pertaining to investments in partnership firm will not include investments in LLPs. That is why the investments in LLPs will be disclosed separately under other investments. Will be disclosed under other investments. I believe this point is clear to each one of you. Next thing. In my personal experience, this is also one of the area where majority mistakes are happening. Let us see whether people are committing mistakes or not. In some cases, the company has given capital advances for procurement of property, plant and equipment. So he gave advance money into vendor for purchasing plant and machinery. It is a capital advance only. So one company disclosed the capital advance under the subheading capital work in progress. Another company disclosed the same as short-term advance, as the PP was expected to be received in next month from the reporting date. So basic question is whether capital advances shall be classified under capital work in progress or not, number one. Number second, if this capital advance is going to be adjusted with the property, plant and equipment to be received within 12 months from the reporting date, then can we say that this capital advance is short-term advance? Yes or no? At least this capital advance is not a capital work in progress. And what about this thing? Can we say this is short-term advance? Because I'm going to receive the machinery immediately after the expiry of financial year. Answer again is no. Let's see how. So when we say capital advances, they are having a separate line item itself. Capital advances are shown separately under the heading long-term loans and advances and are not classified under capital work in progress. So when you will refer general instructions given by Schedule 3, in the general instructions, capital advance is a separate line item below long-term loans and advances. So please be careful. Don't club capital advances in capital work in progress. They will travel into long-term loans and advances. Now, guidance note further says that typically companies do not expect to realize capital advances in cash. Typically, companies do not expect to realize capital advances in cash. Rather, over the period, these get converted into property, plant and equipment and intangible assets, which by nature are non-current assets. Hence, capital advances should be treated as non-current assets, irrespective of when such assets are expected to be received, and should not be classified as short-term or current. So what they are saying, because the advances are in nature of non-current category. Why they are non-current? Because these are paid for purchasing non-current assets. So they should also be attributable as a non-current feature only. However, my view is different. My view is different because this capital advance is also one of a separate line item. So if capital advance is having a feature that if the vendor will not be able to deliver the plant and machinery in time, say within next 12 months from the financial year, then this capital advance will be refunded. In that case, my view is it should be taken as short term. But because guidance note has given a rule, we have no other option but to follow. So guidance note has given a rule that these capital advances should be treated as non-current only. Am I clear? So two mistakes, let me repeat. Mistake number one, don't club capital advances with capital work in progress. Second is capital advances, please don't classify it into current category. It will be into non-current category only because of the requirements given by guidance note itself. There is a question in the chat box. Loan taken for working capital requirement will be under current liabilities or non-current? Quite obvious, current liability only. So working capital loans will be under current liabilities only. Because these are payable on demand also. See this thing. The issue is, if you refer accounting standard 3, there is a question again, analogy cannot be applied here. This participant says analogy could not be applied here. Quite obviously, analogy cannot be applied because working capital loan is not meant for non-current assets. Working capital itself is current assets minus current liabilities. Rather, I should say one more thing. If you are using working capital for purchasing plant and machinery, it is a qualification in CARO. Short-term funds used for long-term purposes. So the analogy cannot be applied because if you apply that analogy here, it will warrant a qualification in the audit report as well. Because working capital itself is current assets minus current liabilities. See this question. To have this question, there is a background. If you refer accounting standard 3 says that deposits with original maturity of 3 months or less only should be classified as cash equivalents. Meaning thereby, bank balances which are held as margin money or security against borrowings are neither in the nature of demand deposits nor are readily available for use by the company and accordingly do not meet the aforesaid definition of cash equivalents. For example, FD, fixed deposit. You borrowed long-term loan after giving fixed deposits as a security. Now this fixed deposit cannot be, broken up on a premature basis. And that is the reason this FD cannot be classified as cash equivalent because it cannot convert it into cash within a period of 3 months. That is what AS3 says. But if you go to Schedule 3, Schedule 3 says something different. Schedule 3 says that cash and cash equivalents comprise of balances with banks held as margin money or security against borrowings, guarantees, etc., and bank deposits with more than 12 months maturity. So see the conflict. AS3 says FDs which are given as collateral are not cash equivalents. Schedule 3 says FDs given as collateral are cash equivalent, and Schedule 3 also says bank deposits having more than 12 months of maturity are also cash equivalents, whereas AS3 is having the window of 3 months or less only. So there is a conflict of AS3 and Schedule 3. Moreover, Schedule 3 says that AS will override me. The question arises how to resolve this conflict. How to resolve this conflict? Any answer? Your client must be having these kind of FDs. So your client may be even having FDs of more than 12 months maturity. Now Schedule 3 says, if your client is having FD of more than 12 months maturity, it is a cash equivalent. Accounting Standard 3 says, if your client is having FD of more than 12 months, it is not a cash equivalent. So which literature I should honor, AS3 or Schedule 3 or both? Answer is both. I should honor both in a manner that AS3 is also complied with, Schedule 3 is also complied with. For this purpose, just see what guidance note stated. Guidance note says that AS would prevail over Schedule 3 and hence the company shall make necessary modifications in the financial statements. What are these modifications? Schedule 3 says accordingly, the conflict should be resolved by changing the caption cash and cash equivalent to cash and bank balances. So what you will do? In balance sheet, the line item is cash and cash equivalents. You will change the heading and you will rename it to cash and bank balances. And then you will have two subheadings. So below cash and bank balances, you will have two subheadings. One is cash and cash equivalents, and another is other bank balances. The former means cash and cash equivalents. The former should include only the items that constitute cash and cash equivalents defined in accordance with AS3. And the latter, other bank balances, will include the remaining line items as far as Schedule 3 is concerned. Are you getting my point? So FD of more than 12 months, FD of more than 12 months will go here, other bank balances. Am I clear? So this is also one of the common mistake which people are still committing. Share application money, I already discussed when even Priya ma'am replied 60 days criteria, but one thing is pending. See this question. So theoretically we discussed, now let us have a practical application. There's a company RST Private Limited. Let us assume this data is given to you in the balance sheet of RST Private Limited as of 31st March 2022 and 31st March 2021, something is reflected. Now Schedule 3 is over. I'm coming into audit report scenario. So this question belongs to audit report. So let us assume you are the auditor and you came to one observation. In balance sheet, it is stated share application money pending allotment. And this money was received by company on 16th January 2021. The money was received on 16th January 2021. It remained outstanding to be allotted and refunded as on 31st March 2021. It also remained unallotted and unrefunded on 31st March 2022. So my question to the people is, as an auditor, what you shall not overlook? I repeat, as an auditor, what you shall not overlook? Any answer? And now don't think from Schedule 3 or notes to accounts angle. Think from auditor angle, because Raghavan sir gave me the duty of covering common mistakes in financial statements and audit reports. So financial statements primarily over, audit reports commenced. Raghavan sir, because you gave me this topic, so this question is to you as an auditor. And I know Raghavan sir is very famous. Even I have saved his name in my phone, Auditor Raghavan.
Sir, Raghavan sir is very famous for passing, sir. My answer would be, we have to make a clear mention in the report that it is violation, since it has not been allotted even earlier, and the same has not been refunded this year also.
So Arun Mugra sir says we can answer if shall look, but they're asking shall not look. I'm not saying shall not look, I'm saying shall not overlook. I didn't use the word shall not look. I'm saying what are the areas that you shall not overlook. See, please take a note. The first contravention is deposit rules. Deposit rules are saying that share application money which is received shall be allotted within 60 days of the receipt. If it is not so allotted, it shall be refunded within 15 days after the expiry of such 60 days. Please see year 31st March 2021. Ask yourself whether this money which was received on 16th January 2021 became deposit or not on 31st March 2021. Answer is no, because exactly 75 days are there. So on 31st March 2021, there is no contravention of deposit rules. But if you travel into the next year, 31st March 2022, the same money still is outstanding. That means on 1st April 2022 itself, sorry, on 1st April 2021, on 1st April 2021 itself, deposit rules are contravened because the money was not allotted and not refunded within overall span of 75 days. So please take a note, para number 3, sub-para number 5. In para number 3, sub-para number 5, auditors are required to report whether the company has contravened deposit rules or not. What is the contravention here? That share application money which was received on 16th Jan 2021 was neither allotted nor refunded even after the expiry of 75 days until 31st March 2022. So this kind of reporting is required in para number 3, sub-para number 5. Para number 3, sub-para number 5 of company's audit report order 2020 deals with reporting by auditors regarding contravention of deposit rules. Number 1. Number 2, please take a note. Section number 143, subsection 3, clause G. Section number 143, subsection 3, clause G of Companies Act requires the auditors to report as to whether directors are disqualified. Directors are disqualified under section 164 subsection 2 of the Companies Act. I repeat, section number 143 subsection 3 clause G of the Companies Act is requiring the auditors to report as to whether directors of the company are disqualified or not under section 164 subsection 2 of the Companies Act. Please take 30 seconds of time, see this question, and please tell me whether directors of RSC Private Limited are getting disqualified or not under section 164 subsection 2 of the Companies Act. Is there any disqualification attracted? If the answer is yes, obviously auditors have to report. Your time is running out. 30 seconds I gave you. For this, you can search Google also, no problems. Now, Raghav sir is having a big smile. So for your benefit, let me show you what section 164.2 says. I will not read it. Read on your own and tell me whether any disqualification is attracted or not. See this block. Section number 164.2 says, a director shall be disqualified if the company has made default in annual filing. In my question, there is no default in annual filing. Or second default is, the company has defaulted in repayment of deposits or interest thereon, debentures or interest thereon, or dividend for a period of more than equal to 1 year from due date. The deposits due date in my question, arrived on 1st April 2021, the day on which this share application money became deemed deposit by virtue of contravention of deposit rules. So the due date to refund this money arrived on 1st April 2021 because it became deposits as deemed deposits. And exactly 1 year took place on 31st March 2022. And the law says exactly 1 year also. So because the money was not allotted, money was not refunded towards deposits repayable for exactly 1 year from due date, 1st April 2021, the directors of company RST Private Limited are disqualified. And because there is a disqualification by virtue of, I repeat the section number 143 subsection 3 clause G of Companies Act, auditors are required to report whether the directors of RST Private Limited are disqualified or not under section number 164.2 of the Companies Act. I believe this point is clear to each one of you. Now just see how ROC will see this balance sheet. Registrar of Companies will be having this balance sheet and he will be able to see this figure. Automatically, he will be having a fittest case to issue a show cause notice that why you should not be adjudicated. Are you getting my point? The balance sheet itself is telling you that you are at fault. An auditor will be also called upon. Why? Because audit report is silent about disqualification and CARO para number 3, subpara number 5. So I believe this point is clear to each one of you. Other matters regarding audit report. Just see simple matters. So this left hand side is a mistake, right hand side is correct elements. So what happened? Just see here. Give me a moment. Auditor has signed the auditor's report prior to the date when the financial statements were signed and authenticated by directors of the company. Is it correct? Answer is no. The date of audit report shall be the date after the date of approval of financial statements or the same date. Same date is also allowed. So the same thing is written by SA 700, auditing standard number 700. What it says, since the auditor's responsibility is to report on the financial statements as prepared and presented by the management, the auditor should not date the report earlier than the date on which the financial statements are signed or approved by the management. You see the word earlier. Meaning thereby it can be the same date. It can be the same date, but cannot be a preponed date. Are you getting my point? Next, auditor has mentioned his membership number with the prefix F in the auditor's report. So say the membership number is 12345. The auditor signed the report and the membership number was written as F12345. or it was written A, 1, 2, 3, 4, 5. A means associate, F means fellow. This is not allowed. ICI never allotted you number with this kind of fanciful scenario. So SS 700 and ICI both are clarifying this thing. Neither institute allows membership number to its members with any prefix like F or A, nor SS 700 permits such use. So please don't use any kind of fanciful elements along with the membership number. Then one of the audit report was there on the signature part. It was the signature area for XYZ and associates, chartered accountants, ABC, partner membership number. What is absent? Firm registration number. So when you sign, please be careful that you have to provide a firm registration number. And that is the same thing written over here. That firm registration number is also required to be given. Next. So this paragraph was reported by auditor. We report that financial statements are reflected true and fair view in case of balance sheet, statement of affairs, in case of P&L. So what happened in case of P&L, the auditor used the words profit or loss for the year. So auditor is saying we report on profit or loss for the year. Now institute says either you can have profit or you can have loss. So you cannot use both the words profit or loss. Use only one word, otherwise readers will get confused. So you have to use either the profit or the loss word as the case may be. Next, the auditor has given the report, but without using the headings. You know very well in audit report, separate headings are there. Opinion paragraph, basis for opinion, TCWG responsibility paragraph, auditor responsibility paragraph, other matter paragraph, legal and other regulatory requirement paragraph. So institute says that always give headings to your various paragraphs. So in this report, paragraph headings were not there. It's a mistake. Next. The title was audit report. Is it the correct title? No. When you issue your audit report, the title of audit report is not auditor's report. The title is independent auditor's report. So you have to add the word independent here. So correct title is independent auditor's report. I have a small question which is not in my clip. I am asking question out of my experience. Please try to respond to my question. Is it mandatory or optional? Is it mandatory or optional to issue audit report on the letterhead of the chartered accountant? I repeat my question. Is it mandatory or optional to issue the audit report on the letterhead of the chartered accountant? You can take a note of this question here, a notepad, because this question is not in my PPT. So letterhead is mandatory or not? And if it is mandatory or optional as a case may be, where it is written? Is it written somewhere? It's something like my heart says it is mandatory. That is why it is mandatory. Please take a note. Revised Code of Ethics. Revised Code of Ethics has stated this under clause number 7, part 1, schedule 1 of the Chartered Accountants Act. In simple words, Revised Code of Ethics states that auditors have to issue the audit report only on their letterhead. So letterhead is mandatory. Letterhead is mandatory. Next. Just see, one of the audit report was there, and in the signature area, he was using the word for and on behalf of X, Y, Z and associate chartered accountants, etc., etc. Please remember, this kind of mistake happens when you do copy paste. For and on behalf of board of directors is correct. But when you come to chartered accountancy as an auditor, the proper words are for X, Y, Z and associates. So for and on behalf of is wrong. The proper words are for X, Y, Z and associates. So these words and on behalf of, these are wrong words. So please don't use the words and on behalf of. You are not agent of your firm. You're a partner. So don't use the word on behalf of. Proper words are for X, Y, Z and associates. Next, one of the audit paragraph was, we have audited the attached balance sheet of XYZ Limited as at 31st March 2012 and related P&L. So there is no word called related. No P&L is related to balance sheet. So please don't use the word related. P&L is independent of balance sheet. Balance sheet is independent of P&L, although they can have inter-se relationship. So please don't use the word related. Even section 129, section 143, SS 700, these literatures are also not using the word related. So related P&L, related cash flow, these words are not allowed. Simple words are P&L and cash flow. Opening paragraphs audit report use the word we have examined the attached balance sheet. Please don't use the word examined the attached balance sheet. The words are we have audited the word balance sheet. Are you getting my point? So don't use the word examined the balance sheet. The words are audited the balance sheet. In audit report, no reference was made to cash flow statement in the opening paragraph. So if your client is going to prepare cash flow statement, you also need to refer cash flow statement in your audit report. Are you getting my point? So cash flow statement, if it's prepared by a client, also refer cash flow statement in your audit report. This mistake is very common. Even today, people are using the word examined the balance sheet. The proper words are audited the balance sheet. Next, I am using a sentence. Please tell me whether my sentence is right or wrong. You issued a qualified report and the words were on the basis of information and explanations given to us together with our audit subject to inventory being valued on a LIFO basis, which is not as per accounting standard 2 and which has resulted in misstatement of inventory and profit figures by rupees 10 lakhs each. We report that dash dash dash. So I'm repeating one sentence again. Please tell me whether this sentence is correct or incorrect. Subject to inventory being valued. Forget about left and right words. Subject to inventory being valued. Is there any mistake here? Subject to inventory being valued. Any mistake here? Let me cut short. Subject to, whether the words subject to are correct or not. Let's see something is there in chat box. Subject to inventory is vague. The answer from Mr. Anand. Answer is not clear. See, earlier days, the word subject to was allowed. But SS 700 was revised. And the words subject to now cannot be used. I repeat, the words subject to cannot be used. Just see, let me show you. I will come back. Just first see this thing. Please take a note. Para number A20 of SS 705. Para number A20 of SS 705 says, when the auditor expresses a qualified opinion, it would not be appropriate to use the phrase such as subject to in the opinion section, as these are not sufficiently clear or forceful. So what are the proper words? Proper words are except that. EXCEPT. So please take a note. The proper wordings are except that, not subject to. This is by virtue of SA 705 revised. R means revised. So earlier it was allowed, but because now standards have been revised, the word subject to cannot be used. Let me go back because I skipped some clips. See here. This I covered in, let me read. The auditor has reported, we have audited the attached balance sheet of X Limited as a 31st March this and this, and profit and loss account for the year ended on this date annexed thereto. The financial statements are the responsibility of company's management. So here auditor went wrong. Why? Because the standard requires management responsibility and auditor's responsibility shall be separately mentioned on the face of audit report by making two separate headings. Number one, responsibilities of management and TCWG. What is TCWG? Those charged with governance, like audit committee. Audit committee is TCWG. Board of directors is management. And second paragraph will be auditor responsibility for audit of financial statements. So what the institute says, you cannot simply say financial statements are responsibility of company's management. You have to give the responsibility of management and TCWG in separate paragraph, auditor responsibility in separate paragraph. Next. An unqualified opinion was given in this fashion. In our opinion, the balance sheet, the P&L, the cash flow statement dealt with by this report comply with the accounting standards referred to in section 133 of Companies Act. Auditor often omit to state whether the statements prepared are in conformity with the financial reporting frameworks or not. Let me tell you what is the mistake through an example, because theoretically it will not be that much understandable. Just see this thing. Can you see this red area? So what companies were doing, just I'm reading this paragraph. Please focus on my words, but I'm saying oral words, and just see how I'm reading. In our opinion, and to the best of, let me change something. Give me a moment. Just a moment. You will get to know. Auditors were reporting only this paragraph. What they were reporting, in our opinion and to the best of our information and according to the explanations given to us, except for the effects of the matter described in the basis for qualified opinion section of our report, the aforesaid financial statements give a true and fair view of the state of affairs of the company as at 31st March 2022 and its profit and cash flows for the year ended on this date. So what the auditors are doing? Auditors are merely writing, give a true and fair view. Auditors were merely writing, financial statements are giving a true and fair view. This is a mistake. Why it is a mistake? Just see what was required. These red fonts were missing. These red fonts were missing, or I should say this red sentence was missing. So what is the proper scenario? Proper scenario is aforesaid financial statements give information required by the Companies Act 2013 in the manner so required and give a true and fair view in conformity with the accounting principles generally accepted in India. So earlier, and even today it is happening, auditors are reporting, give a true and fair view. But the standards are requiring to identify the financial reporting framework also. And what is the financial reporting framework? Companies Act as well as accounting principles. Am I clear? Are you able to understand what was the mistake and what should have happened? The mistake was only green words were given. And the correct scenario is not only green words are required, but these red words are also required. Am I clear? Just see theoretically now. Theoretically now things will become easy. SA 700 requires that opinion para of auditor's report should clearly indicate the FRF. FRF means financial reporting framework used to prepare the financial statements and state the auditor's opinion as to whether financial statements gives true and fair view in accordance with the FRF, and where appropriate, whether the financial statements comply with the statutory requirements. This FRF and statutory requirement is nothing but these red sentences. Am I clear? Now, this I covered already, that subjective words are not allowed. Just see this thing. This I covered. I mean, these two boxes I covered. Now see this third box. Membership number of auditor was mentioned in the audit report, but not in CARO, balance sheet, statement of P&L. You sign on CARO also. Each page is initialed by you. You sign balance sheet also. You sign P&L also. You sign cash flow also. So wherever you are signing, your membership number is required along with the firm registration number. So if you are using your office seal, that round seal, and in that round seal, if your membership number, firm registration number is given, no problem. It is correct. But if your membership number or FRN is not there, then you have to write with your hands, or you may need to typewrite it. But membership number, FRN is required on each and every page wherever you are putting your initials. Report was not addressed to anyone. So entire report was prepared, but at the beginning, you are not writing to the shareholders of the company. You have to write to the members of the company, to the shareholders of the company, as the case may be. So addressee is required. One small change. When it was Companies Act 1956, when it was old Companies Act, and you are required to report on consolidated financial statements. So when you are preparing audit report on consolidated financial statements in old Companies Act, you are writing to the board of directors of holding company. Now things have changed because of Companies Act 2013. Under Companies Act 2013, if you're going to report on consolidated financial statements, you will not address the board. You will address the members of holding company. Am I clear? Just see this thing. Under the Companies Act 2013, audit report on consolidated financial statement will be addressed to members. Earlier it was addressed to board of directors. Next. Matters to be looked into CARO. So I covered this CARO episode when I was discussing Schedule 3, Schedule 2 share application money. So I will not repeat this thing. Only one thing I will touch upon for this Caro. Balance things I have covered, so don't worry and don't be under impression that I'm skipping. I'm not skipping anything. I have covered all these paragraphs when I was discussing the previous versions. The things which I have not covered, let me touch upon that thing. This I didn't cover. So let me ask you this question. This is the company RST Limited. Caro is applicable because RST is a public company. So the effects are gratuity is payable under Payment of Gratuity Act and bonus is payable under Payment of Bonus Act. The company has delayed in making such payments. The company also has delayed in transferring the amounts to Investor Education and Protection Fund. Question is simple. Whether such delay in payment of gratuity, bonus and IEPF is reportable under Caro Para 3.7. Let me remind you, Para 3.7 of Caro deals with statutory dues, whether the company was regular or not in depositing statutory dues. So please tell me whether this delay in payment of gratuity, delay in payment of bonus and delay in transferring amounts to IEPF, whether these three delays are reportable or not under Para 3.7 of Caro. Let me see if some answers are there in chat box, I believe. So my dear friend Aru Mugaraj says yes to be reportable. Answer is wrong. My another friend Narsima Raghavan sir also says yes. Answer is wrong. Now Priya ma'am will not respond. Arun Kumar sir says no. Okay. No, answer is correct. But can I know the reason? What is the reason of this no? Yes, correct. Arunji, your answer is correct. Please ask yourself whether gratuity, bonus, forget about IEPF for the time being, whether gratuity, bonus are statutory dues. These are statutory liabilities. These amounts are payable to employees, not to the government. And Para 3.7 requires statutory dues. Statutory dues means the amount payable to the government, like PF, ESI, GST, advanced taxes, self-assessment tax, etc. So gratuity and bonus are statutory liabilities, but these statutory liabilities are not towards the government of India or state government. These are towards the employees, and hence these are not reportable under Caro. What about IEPF? The reporting about IEPF is nowhere prevalent in Caro. In previous Caro, it was there. Now IEPF reporting is not there in Caro, it is deleted. So conclusion is this way. Let me show you conclusion. Conclusion is this way. You can take a note. It is not typewritten over here. Conclusion is gratuity is payable to employees, bonus is payable to employees, and hence these are not reportable under Para 3.7 of Caro. About IEPF, you can see my screen. IEPF deposit delays are not reportable under Caro. They are reportable under Rule 11 of companies audit rules. What is Rule 11 saying? Rule 11 says report about litigation pending, if any. Report about IEPF delays, if any. So on the face of the audit report, you must have seen other reportable matters. In other reportable matters, IEPF shall be reported. It is not reportable under Caro. Am I clear? Now, see this question. Whether the following reporting made in Caro is correct. This is the last question. Then we will wrap up and I will take your questions, if any. The question is whether the following reporting made in Caro is correct. So one of the auditor reported in Caro, according to the information and explanations given to us, no fraud on or by the company has been noticed or reported during the course of our audit. Is there any mistake over here? And I must tell you, if you will see your own audit report, in your own audit report, you must have committed this mistake. Raghavan sir, please check whether you have committed this mistake or not. No fraud has been noticed or reported during the course of our audit. If you have committed this mistake, at least don't say anything on this platform because the meeting is recorded. Please take a note. These words, during the course of our audit, these words are wrong. These words are wrong. During the course of our audit or during the period of audit, these are not used. The proper word during the year. During the year. The Caro is using the words. Caro is using the word during the year. Not the words during the course of our audit. Am I clear? So the proper words are company has been noticed or reported during the year, not during the course of our audit. Am I clear? So Raghavan sir, this is it from my side. Now I am open for the questions from the audience. So if there are any questions, you are most welcome. I am stopping the screen share and you can ask the questions. It's an open house. I have kept 5 minutes for question and answer session. If you have any questions, you are most welcome.
Everybody who having the question can post it in chat box also.
There's a question from Mr. Arun. I have a doubt in relation to self-assessment tax or advance tax. Will that be reported in Caro? Arunji, this will be reported in Caro only if there is a delay in payment of advance tax or self-assessment tax.
Yeah, I have one question.
Yes, sir.
When you are just talking about the share application money, some slide which is it not a violation to be mentioned in 31/3/21 itself? At least by way of
It is not the violation regarding
31/3/21 itself, because they have not allotted it in 60 days. The balance sheet has been signed after the expiry of 75 days.
Yeah, it is a violation, but my objective of this coverage, you are right, it is a violation. But my objective is to tell a basic point of directed disqualification. Otherwise, contravention is there, I agree. So because I was covering common mistakes, so one of the common mistake is auditors report about contravention of deposit rules, but they forget to report about directed disqualification. That was my objective.
But is it considered as an adjusting event, so to say? Because
yes, it is an adjusting event.
Okay.
For this purpose, you may refer two things. One is accounting standard 4, and second is auditing standard number 560.
All right. Thank you.
In Tamil, I believe 560 is Anja Ara Pujyam. Correct?
Yes.
Or common mistake happened here also.
You're perfectly right.
Okay.
I have a very small and basic question on applicability of Caro. I am a small company who's had around 10 crore of outstanding loan at any point of time during the year. So is Caro applicable to me?
Not applicable. If a company is a small company, irrespective of the borrowing it is having, Caro is not applicable. So this is one of the common doubt I have seen and come across pan India wherever I traveled. This question is still there. And now let me add one more question to it. Please tell me, this question is to each one of you because we are focusing more on borrowings, but still we are missing one point. Let us assume this way. There is a company ABC Private Limited. Its paid up capital is say rupees 1.90 crores. Its paid up capital is 1.90 crores. Reserves and surplus are 20 lakhs. Turnover of the preceding year 18 crores. Now tell me whether it is small company or not. I repeat the figures. I must tell you one more thing as a matter of precaution. To classify a company as a small company, you need to check turnover of the preceding year, not of the current year. So let me share the data. The paid up capital is 1.90 crores, current year only. Current year reserves and surplus are 20 lakhs. And preceding year turnover is 18 crores. Whether this company ABC Private Limited is a small company or not. I got one answer from Vishwanath ji, small company. He says it's a small company. Any other answer? Priya ma'am also says, yes, it's a small company. So what is the precaution here? The precaution is for classifying a company as a small company, reserves and surplus are not used. It is only paid up capital. I have seen chartered accountants that are using even reserve surplus as a part of your paid up capital threshold. Please understand, reserve surplus are not the part of paid up share capital threshold when you assess company as a small company or not. So the simple thing is to assess and evaluate whether Caro is applicable or not. Step number 1, check whether the company is small company or not. If the answer is yes, it's a small company, no need to do anything. Caro is not applicable. Step number second, if answer to step number one is no, that it is not a small company, then step number second is check whether the conditions given for private company are fulfilled or not. Step number three, if all the conditions of private company, which is not a small company, are fulfilled, then CARO is not applicable, else CARO is applicable. Am I clear? And there must be one more doubt in the minds of the listeners. On 15 September 2022, the threshold for small company enhanced. So whether this enhanced threshold is meant for your financial year 21-22 or not. In fact, Priya ma'am is smiling because we had a good discussion on this parameter. So what is your take, listeners, whether 15th September notification is applicable for financial year 21-22 or not? Answer is no. Because whether a company is a small company or not, that status is examined on the balance sheet date. On the balance sheet date, 31st March 2022, these limits were themselves not existing. And since these limits are applicable from 15 September 22 and onwards. So when we say and onwards, it means that on 31st March 2022, old limits are applicable. On 31st March 2023, new limits are applicable. When this AGM will be conducted, so there could be certain small companies whose AGM is due on 30th September. For these small companies who were earlier not small companies, for these small companies who became small companies on 30th September AGM, the privileges available to small companies like rotation of auditors and certain other privileges, these privileges will be available only for year 22-23, not for year 21-22. So whatever annual return will be filed for year 21-22, that will be based upon old limits only, not the new limits. So that we need to be careful about. So in simple words, 15th September 22 notification is meant for fiscal year 22-23 and not for 21-22.
Similarly, we can also have a small discussion on earlier point we've discussed personally. That is on financial statement as on 31/3/2021 signed today. What will be the consequences?
In that very case, if 31st March 2021 financial statement is signed today, first thing is whether these financial statements belong to small company or not shall be based upon the limits that existed earlier. Paid up capital not exceeding 50 lakhs and turnover of preceding year not exceeding rupees 2 crores. Because the new limits prior to 15th September were applicable from 1st April 2021. Number one. Number second, because these financial statements are belatedly filed and signed, the applicable consequences of late fees and penalties will be there as well.
The amended Schedule 3.
Schedule 3 will be of that time only. So the statutory format, you cannot apply it retrospectively.
One question.
Yes, sir.
When we are discussing CARO, you said payment of gratuity or bonus is not reportable at CARO, that particular point.
I said it is not reportable as a statutory due.
It is not even reportable.
See, in CARO, this gratuity and bonus is not reportable as statutory due under para 3(7). But it is reportable under other clauses like internal control system. It is reportable there.
Sir, one doubt. What happens? See, I am a company, a small company, as per the September revised rules. But then I also have a subsidiary and an associate company. So will I be? Will we do CARO for this?
The first thing is, if your company is having a subsidiary or holding of any nature, you will lose the status of being a small company.
Right.
Second thing is whether CARO is applicable or not, that depends upon what is the nature of company. Is it a private company or a public company?
Right.
So it's a private company and this private company is a holding or subsidiary of a public company, CARO always is applicable.
Right.
If it is a public company, CARO is always applicable. But if it's a normal private company, holding or subsidiary of any other private company, then for all the companies, you have to check the thresholds meant for Caro's applicability.
For the respective companies.
For the respective companies, because Caro is evaluated on company by company basis.
A standalone basis.
Standalone basis.
Right.
There is one more small basic clarification regarding OPC.
Regarding OPC.
OPC. Yeah. We say that there is no requirement of holding an annual AGM or a board meeting as per the law. But, and as per my understanding, whenever an event takes place, you just need to record it in the minutes of the meeting, and that would be considered as a board meeting date. So, can you just throw some more light on this?
See, as far as AGM is concerned, AGM is not required for OPC. And that is why the law says within 180 days of financial year, you have to file. As far as board meeting is concerned, there can be two situations. Number one, the individual who is the member is also a director with no other director or member. In that very case, the board meeting shall be conducted on fictional basis. Now, what is the meaning of fictional basis? This fictional basis is not given by the Companies Act. Because Companies Act says if you are OPC, there is no need to conduct board meeting. So let us assume I am an OPC. I didn't conduct any kind of board meeting, but I still need to minutize my decisions. And this minutization is known as fictional meeting. So on the letterhead of the company, by putting the serial number and other things, I will record the minutes. And these minutes are known as fictional meeting minutes. So this is the practice which industry adopts. Otherwise, the law is silent. So I will be preparing my letterhead and I will writing minutes of the decisions taken by me as a director of OPC. So in a way, I will be documenting my own decisions. Just like auditor maintains working papers. Similarly, the OPC director will maintain his working papers also, but technically these working papers are called as minutes.
And with respect to minimum one resident director, which is a requirement of the Companies Act. In case of OPC also, recently during COVID times, they had relaxed that even an NRI can incorporate an OPC.
Yes.
But that's the contrary that you may not have a resident director residing within 120 days, which was recently reduced as well. So how it looks like a contrary. So how do we really take it as a...
See, as far as this contradiction is there, this is the ground reality and people are facing problem. So as of now, I don't have any solution. Only thing is I need to approach ROC to give a certain relaxation.
Even we as an auditor, when we qualify it in the report, or how do we state it? Because
surprising thing is when you file the forms, they allow filing. But as a chartered accountant being statutory auditor or as a company secretary being secretary auditor, you have to report this violation.
Okay. So even in the audit report, we need to mention this.
Why this is a requirement to report in audit report? Because this kind of element may lead to striking off of the name of the company.
Okay.
Because the company is not properly constituted with the proper directors. Now this 25B also came in, no? So 25B, section number 12, all these things read together may lead to striking off.
Right, sir.
Sir, one more doubt. Previously, in the financial statements, generally UDIN will not be affixed. So, can we still continue to have that stand, or should we change and have the UDIN in the financial statements?
Sir, I'm not able to understand your question. Your voice broke up.
So, in the balance sheet, P&L, cash flow statement, should we have to mention UDIN? Because UDIN is for the purpose of auditor and it should be in the audit report. But there is no mandate that it should be there as part of the financial statements per se. So can we continue to have this stand?
I would not endorse this thing that there is no mandate. Mandate is there by virtue of SS 700, which says that auditors have to sign the audited financial statements also. So wherever you're putting your membership number, firm registration number, UDIN always will be tag along. So UDIN is required even on balance sheet, even on P&L, even on cash flow, along with the audit report.
Okay.
But in many big fours, we find that it is done only in the audit report. Otherwise, in financial statements, we are not finding
That is the travesty of this whole practice. We always take Big Four as a benchmark, whether without referring what SS is. That is a travesty.
Okay.
And this travesty is a kind of irony also. When you generate UDIN, in UDIN, the figures are being punched from the balance sheet and P&L.
True.
So it is quite illogical when you say, I will put the UDIN on audit report face, but I will not put UDIN on the balance sheet, the figures of which are punched on UDIN portal.
Agreed.
So for declaring dividend, whether the accumulated profit, that is retained earnings, needs to be considered as free reserve, or will it come under that 10%?
When we say accumulated profits or retained profits, we have to be very particular about one thing, whether these profits are distributable or not.
Okay.
So for example, all the retained profits are not distributable. Sinking fund, for example. Sinking fund could be accumulated out of P&L, but it is not distributable.
Okay.
Revaluation reserve, which was transferred to general reserve on disposal of property, plant and equipment. Because once the property, plant and equipment is sold out, the corresponding revaluation reserve is not required. So what we do, we transfer revaluation reserve to general reserve at the time of disposal of property, plant and equipment. That is not available for dividend distribution.
Okay.
So if I assume that your accumulated profits or retained earnings are not comprising free profits, these reserves can be used, these profits can be used for dividend distribution.
What do we refer as free profit here?
Sorry?
The sinking fund. What do you refer as free profit here?
Free profits means the profit which are accrued by virtue of normal business operations.
Okay. Okay.
For this purpose, you can refer, if my memory serves me right, section number 2, clause number 43, which defines free reserves.
Okay, it was work, so I thought of getting clarification here. Okay, thanks, Venu.
Good evening, sir.
Hello, sir. How are you?
Happy to see you in the virtual mode.
Same here. I am also happy to see you, and thankfully you gave your darshans to me.
Just one question, sir. Section 8 companies can be voluntarily wind up. It's possible.
Section 8 companies can be voluntarily closed down, but only thing is there are some stringent rules. Number one rule is when it is closed down, whatever assets are there as a surplus, they also need to be gone to other Section 8 company.
Okay.
Or if other Section 8 company is not available, then you need to transfer the surplus to a fund.
Okay.
A fund is created by Insolvency and Bankruptcy Board of India.
But it can be done only as a Section 8 company, or we have to withdraw the Section 8 license, sir?
No, Section 8 license is a kind of common parlance. So Section 8 license is basically certificate incorporation you are having.
Okay.
So Section 8 company can be closed down voluntarily. There is no embargo, but yes, procedure is stringent. You cannot sell off this company to any person. You can sell off this company to other Section 8 company only. If that Section 8 company is not available as a buyer, then whatever surplus is there, that you need to transfer to some special fund constituted by Insolvency and Bankruptcy Board of India.
Okay. Okay. Thank you, sir. Thank you.
But this closing down is not easy.
Have a nice day, sir. Thank you.
Thank you, Ji.
For Section 8 closure, don't we have to convert it into a private company and then go ahead?
Absolutely no need. That can be taken care of in the process of voluntary winding up.
Okay.
Otherwise there is no point in closing it down. First, you will convert it into private, and even conversion of Section 8 company into private company is surrounded by so many questions.
Of course.
So that permission itself is quite challenging to be obtained from the regulators. Raghavan sir, you are so silent. I think he's also not able to listen me.
He was muted.
Shall we
Shall we
close?
close the session, Raghavan sir?
Yes, sir. Madam,
This is the only speech I remembered and I memorized it last night.
shall we conclude, sir?
We can conclude. If members have any query, they are welcome.
Request you to
Otherwise,
share the PPT.
Sir, I have one thing. I have one query.
PPT I will share, sir. Immediately after the closure, I will share.
Okay, I have only one question, sir. If a company engaged in trading in shares, securities, whether it need to get a RBI approval, sir?
See, that depends whether it is a principal business activity or not. If it is a principal business activity, then obviously you have to go for RBI approval. For this purpose, I would say you have to refer section 45I of the RBI Act.
Okay.
So please mind my words. I use the words. If it is a principal business activity, for principal business activity, you have to refer RBI law, section 45I.
Okay, even though if there is any limit ceiling on this capital.
Ceiling, I need to check. I think the ceiling is recently revised. It was 100 crores, I believe. Earlier it was 2 crores. Now it is, I believe, 100 crores or so. So limit I need to check. I'm not sure. For limit, you have to check section 45I.
Okay. Thank you, sir. Thank you.
But yes, one thing I am totally sure that limits were enhanced. Okay. I'm confused about whether the limit was enhanced to 100 crores or so other amount.
It's a private limited company only.
Even then.
Okay. Would the answer be different if it is my own shareholders' money I have taken and I've invested in the shares, equity shares or whatever? But would that be different?
Then it would be different. Then it would be taken as a collective investment scheme. So in that very case, you have to comply with SEBI law also. Collective investment scheme, because you're collecting the money as a pool of funds and then you're investing. Yeah. So there's a concept in your SEBI law, collective investment scheme, section 11AA, I believe, of SEBI Act. Don't ask the dangerous questions.
Right, sir.
Thank you.
Thank you, sir.
Pleasure, man.
I, on behalf of Chengalpattu District Branch of SIRC of ICI, very glad to thank you all for your presence with us today. Also thank the speaker of the day, Shri A. Kamal Garg, who's very close to all of us. In fact, you have always been giving us deeper insights with your immense knowledge and expertise, and you have proved it today as well. As usual, it has been spellbound for all of us. I thank the whole team members and the chairman and secretary of the branch for this wonderful program. I also thank the management committee members of the branch. And I also place my happiness that you've been throughout with us today for participating wholeheartedly and making this program a grand success. Thank you. Thank you, Kamal Garg. We will always be asking you many more such programs, and specifically a physical program when we are here in Chennai with us.
Surely. Raghavan brother, I have sent the PPT. You can check and you can circulate.
I'll just check. Thank you very much.
Thank you, sir.
Thank you.
Thank you, audience. Have a nice time ahead. Thank you very much.
Thank you.
Don't forget to give a call.
Surely, I will do. Just now.
Thank you, sir. Babu, end panikanga.